So first of all, for those of you that can't see, Suzette Evans is on this conference call with us. I wanted to personally thank her for her assistance with pulling this together. She was the person who helped us get into the memberships with NELA and ITRA. I also want to thank both of those associations for the opportunity. I have had some experience with both organizations, and some of you may know or we've met, either through my presentations at NELA and ITRA or just by doing business together. So with that said, I'd like to start the presentation. Just so you know, I'm located, our offices at BRS, Business Resource Services, we're headquartered in South Burlington, Vermont. I'm located near Boston, and we do work with clients all over the country. So hang on one second, here we go. Okay, so about BRS, briefly, we are a team we have financial specialists and engineers, and the reason I wanted to mention the spectrum of who we have on staff is because it's fine to understand how to calculate this credit financially, but it's equally or maybe more important to understand from an engineering point of view what each of our clients are doing technically, and to have the ability to focus and understand our clients' technologies and engineering resources, or technical resources, allows us to really maximize the credit for them, because we have a more thorough understanding of what they're doing. So that's the main reason I wanted to mention that. The other thing is, we've been doing this for now, collectively our team, probably 30 years, and in those 30 years, we've never had a claim denied by the IRS or any state tax agency. So, we've got a very good methodology of how we go about this. So let's talk about the credit. So this tax credit's been around for actually quite a few decades, and it was always temporary and extended by Congress. And finally, in 2015, they made it permanent, a permanent part of the code. And then in 18, it was preserved, where many credits were actually diluted or taken away. It was preserved under the Tax Cuts and Jobs Act. And in fact, there were some positives that came out of that legislation for the R&D tax credit in particular. There's no limit to the amount that you can qualify for. And I just thought I'd make a note. This really should be called the innovation credit. And I think what happens is, when people think of R&D, they think of somebody in a white coat in a lab doing tests and running tests and experiments. And that's a very narrow view of what this credit really is all about. For anybody who does any sort of innovation, and we'll talk more about what that means. It's a much broader view of the R&D world that the IRS allows. So this credit is really is used to offset taxes owed. We'll talk in a couple slides about how you can go back and actually get refunds of cash, but it's really against taxes owed for C corporations, S corps, and LLCs. Most of the linen service operators that I've dealt with across the country are these flow-through entities like S's and LLCs, and as flow-through entities, these credits also flow through to the shareholders for their own personal use against income taxes. C corps, the credit stays within the corporation and is used against corporate income tax liabilities. So who qualifies? I'd like to talk a little bit about that. Simply put, companies that are attempting to create or improve products, services, or processes. Now, obviously, our audience today are for linen service companies and textile manufacturers, and many companies in our group here qualify, but you're unaware that you qualify. And in fact, it's a very common thread through almost all industries that we deal with. And the reason, some of the reasons are that people don't understand the types of activities that qualify. And I'm going to talk about that. And then they also might have heard about the credit, but you don't really know what kind of documentation is needed to claim the credit. And this is what, I guess I would consider what we do a niche. We center our focus on 10 pages of the IRS code. And I know it doesn't sound like much, but it is very complicated. And there's a lot of interpretation that we end up doing with our clients to make sure we figure out what does qualify versus what doesn't. And I've listed here a bunch of different industries that really use the credits that we've worked with, and I probably could have written 3 times this many. I just wanted to give you an idea. I mean, even you can see my cursor, construction companies often qualify, and you think, why would a construction company qualify? Well, because they do a lot of planning and design and engineering prior to even bidding on their projects and building a project. And those activities up front and those wages and expenses associated with those activities qualify. So we actually work with a lot of construction companies, just to give you an idea. The one thing that I wanted to point out, though, is software and cloud-based solutions are a thread through all industries. Everybody uses software to improve their efficiencies, and often, I've mentioned e-commerce sites. If people have developed their own e-commerce site, or taken an off-the-shelf one and customized it with your own software developers or outside developers that you hire, those activities would qualify. So we'll talk more about that as well. So the benefits of the credit, what I'd like to do is give you a financial example. There are both federal and state credits. Probably 2/3 of the states have their own R&D credit, and mostly it mirrors how the federal credit is calculated, but there's different varieties out there. And so every state we have to look at when we're doing the federal credit to see if a client qualifies for that credit and how much. But up to, if you're in a state where both federal and state credits qualify, then up to 20% of your costs incurred can be used in calculating the credit. And an example of the federal credit would be this. So if in a particular year, you had $500,000 of payroll of people's time that are eligible for and do qualified research activities, then you'd get back about 10% as a federal credit, 50 grand, let's say. The federal credit allows you to go back 3 years and claim what you haven't claimed for R&D credits before. So in this example, and this is a high level example, obviously, if you had $500,000 each year for 4 years straight, with the current year plus 3 years back, you might be eligible for 50 grand a year or 200 grand in total in tax credits. Now, if you were, in those 3 years prior to the current year, if you had paid taxes related to the business, then you'd actually get a refund back in the form of a check from the IRS for amending and taking and claiming those credits. In the current year, you would use it it would be basically included in your tax return. And if you owe taxes in the current year, then it would just be an offset of what you owe. So it's basically the same thing as cash. You don't have to write a check for that amount of the credit. Okay. And the other very positive point is with the federal credit is for any credits you do not use, you can carry them forward for up to 20 years. So that's an overview with a thumbnail of how it works on the federal level. And I'm not going to go into the state level, but basically they vary. In Massachusetts, you can get up to 75% of a federal credit as a state credit. So if you had 50 grand, you'd be able to get whatever that 37 grand as a state credit. California is similar. Vermont is 27% of the federal credit, and it varies across the country. But it's all to help the taxpayer, in the end, invest in innovation. And as far as the states go, this is a current map of those that have qualified R&D programs, R&D tax credit programs. The red ones do not, the green ones do. All right. So what I want to talk about next, and again, feel free to questions along the way. I wouldn't.
Alexa, remind me 3:30 p.m. doctor's appointment.
Okay, I'll remind you at 3:30 p.m.
Oops, what do I do? So, okay. So sorry, I don't know what that was. So we're going to talk about what the qualified research activities versus the expenses, which I'll get to next. So the IRS allows any activities that are related to development or improvement of a product for those who manufacture, development or improvement of a process. That can be for all the linen service operators we work with, as well as manufacturers, and those who develop software for sale or internal improvements. And the one note that I'd like to make is a lot of times when people embark on initiatives that they are trying to improve efficiencies in any of these three categories, that may not work. And the IRS allows the cost that you incur to be used even if it fails in the calculation of the R&D credit. So that's usually something that comes up every year with clients. Talking about product development versus process development. Product development, you go from concept to design to prototyping, testing, and then you do some refinements of it, and you might go back to the drawing board. That's what research activities that qualify related to product development are. On the process side, you might want to improve your throughput. Often if you're a manufacturer and you're trying to include new products into your existing process, then you have to change your process to accommodate that. If you're a rental uniform company and you've wanted to bring in a new piece of equipment, a sorter, for example, you may have to adjust the process and integrate the process on each end of the sorter because it affects both ends of it, the input and the output in terms of the speed, etc. So efficiency of operations, reducing costs, and minimizing maintenance, all of these global categories of activities count. On the software side, as I mentioned earlier, for those who create a product for sale, to be used by customers or third parties, that might be, like I said, an e-commerce site. It could be an e-commerce site, by the way. We all know how they are with banks, but it could be that you've put in a site where you're allowing your customers to track inventory or track their orders, see what the delivery is, et cetera, et cetera. And if you've developed that software, or whether internally or in conjunction with a third party, then that can count. And the internal use systems, this is really, the government over the last 10 plus years has given a little more definition around what this means. But the good news that we feel is they basically allow a company to develop internal software where they're, again, doing their own programming or outsourcing it, to develop and improve performance, quality, maybe it's reliability or functionality. These are all areas that everybody works on at a certain time of their life cycle in the company. So we always do bring this up, and we've seen a fair number of clients in our industry here that we're talking with that do internal use software development. So the government allows, there's 4 tests that they have. I have 5 listed. but they call it the four tests, and these are these four here. But there's really what I would call a fifth one. And what they basically mean, and they say any of the activities that the taxpayer is going to use to claim a credit must meet these four tests. We help interpret how your activities would qualify to meet these tests. So the business component is basically what is that initiative that you're undertaking? Is it a new product or improved product? Is it something to do with your process change? Internal use software? It could be a technique, a formula, invention. They just really want you to have a defined way of describing what the initiative was. So it's just that basic. Then it must be technological nature. So what the IRS says regarding this is the activities must rely on one of the hard sciences. So what is a hard science? It's either engineering, it could be a biological science, particularly if you're a pharma or pharmaceutical. Could be physical science, and that's something that I see with all of the clients I've worked with in our industry here. You're putting in new equipment, you're changing the process. That's what we would consider the physical science. The other one they list is computer science, which is one that crosses all boundaries, as we've spoken about. Then there's the technological uncertainty test, and what that means is simply that you probably planned a project, you may have budgeted for it, but you're not 100% sure that you're going to be able to meet the desired solution or how you might meet that solution. So in other words, are there unknowns technically how to get from A to B? And when you're putting in, let's say, a new monorail system, or you're creating a new product in a manufacturing plant, then you want to get it, you believe you can get it, or you wouldn't put the budget dollars and invest money up front to figure it out. But you still are going to have issues, and that's what that means. There's uncertainty to some degree. And then the fourth one is the process of experimentation. Basically, it just says there needs to be 2 or more iterations of trying to figure out how to get it to be done correctly. So that's an easy one to actually to get over that hurdle. The financial risk one doesn't exactly apply so much to the lend service operators. It's more for actually engineering type companies and consultant types and some manufacturers. Basically what it means is the government wants the party, that whether the taxpayer or their vendor or their customer, whoever owns the financial risk for the activity is the one who can claim the credit. So if I'm investing in efficiencies for my company, no matter what way, software, new products, new equipment, etc., and I know it's just going to make me more efficient, then it's on my dime. It's my risk. And it may work, it may not work as best as I thought. But if I had a customer come to me, and if I were a manufacturer, let's say, and I had a pen like this, and they said, hey, I want you to make this pen with a different clip, different way of opening it, and I wanted to do XYZ. And you said, all right, I can do this, but I will only do it on a time and material basis. And they say, okay, then who owns the financial risk? That customer does, because they might pay you for limitless hours and expenses. But if you said to them, I can do this, but I'll do it for 50 grand, and they say, okay, fixed price, then the manufacturer, would own the financial risk, because guess what? Even if they pay me well, it doesn't matter. As long as I have a budget and I may or may not meet it, and I own that risk, then the government says that I can claim the credit. Now, I don't want to go too detailed on that one. I'm trying to show you that there are criteria that has to be met. And by doing a process with our clients of going through the activities and projects, we uncover what is easily understood to meet these criteria. Okay. A few examples. I'll just quickly go through these. these are activities that can qualify. The planning and testing of the RFID and ultra high frequency chips within your process. Researching processes that can extend material life, improve, obviously improving production methods, planning and designing wastewater treatment plants. I see this often where wastewater treatment has to be improved, made larger, expanded, whatever, to meet expanded demands of the plant. So the planning and design side and engineering counts. Then other quick examples: planning and designing energy, energy efficiency measures. Maybe there's heat recovery systems that you're putting in, and you have to do different testing or you're putting in sorting systems, as we talked about. I've often noticed with people who expand their facilities or build new ones, that inevitably comes with a change or an upgrade or an improvement in your process. So whenever I kind of hear that a major expansion is being done or has been done, my radar goes up, because I then want to know, what have you done regarding your process? Did you move things from your current facility? Did you expand? Did you make things more efficient, and how? That's the types of things that we look for. And in general, whenever you're trying to integrate latest technologies to improve efficiencies, then there's probably some qualified activities that surround it. Now, now I want to do is just 2 slides. One to summarize product development from a qualified activity, and 2, process development. So if you're developing a product, if you're one of us on the call who are making a product, then when you start your concept development is when the R&D begins. You go through engineering, you go through prototyping and testing, and you get to a point where you probably get feedback if you've let customers look at the product, give you feedback, and you go through other testing and some of these things. But when it's time to ship, and you say, hey, we're fully commercialized, turn the switch, we can ship 10,000 units, that's when the IRS says R&D stops and full commercialization begins. So in general, this is what we look for when somebody's developing products. If somebody's improving their process or developing a process, it's similar, but it starts with your engineering through the concept, you're developing system, prototyping and testing, and then there's a point in time when the testing's done and you're fully commercialized and you're producing what you're wanting to do. That's when it stops. Same thing as product. Okay. So I want to give you an example. We've worked with Dave Damaris over at LACO, and he's allowed us to use this as an example. It's a good one because it really does show how something can qualify. So David was looking, had an issue. The soiled linen was coming in inefficiently, due largely because of, he had difficulty in handling the uneven inflow. And he also had space constraints. His main floor was used well, but he had access to a second and third stories that he couldn't really access the right way. So he had an objective, or what I call this business component, that first criteria, the IRS criteria. He wanted to improve and automate the handling and sorting of the soiled product. It's that simple. That was his initiative. So the way he wanted to solve it, and he involved consultants, and had a lot of brainstorming internally. They wanted to implement a gravity-based monorail system, and that would not only allow for the efficiencies on the front side of the soiled linen coming in, but it gave them better access to the second and third floors. And they, the part of this, of course, was that it would have to be designed to efficiently transport and handle these incoming soiled linens and meet these peak demands that I'm sure you're all familiar with that happen. So it had some technical uncertainties. I'm going through the 4 tests to show you how it works. The technical uncertainties were this. He wasn't sure how the volume would be handled. That he also wasn't sure how the demand product would have a timely turnaround. He had a good idea, but he still had these uncertainties of how it would work, even with this new system. And he also had uncertainties how precise the balance of the weight and the incline, because it was a gravity-fed system, had to be. And then the last criteria that he looked at, and he didn't look at it in these ways. This is what we did when we heard about his project. We kind of figured out that this is why this project fit. This project required a lot of experimentation where he had to, do different inclines of the rails and design and adjustments and extensive testing of different loads and weights and volumes. So that's what he did. And, they fabricated their own custom rails. They put in the transport rail function switches, and they put in conveyors. And they did this across their facility. And in the end, they ended up, with a much more efficient process. They ended up reducing the amount of inventory they had to keep in general. And maybe as importantly, or more importantly, they got a decent R&D tax credit because of these activities. Let me just pause to just ask if anyone has any questions at this moment. And if not, I will continue. I'm going to continue now to show how these activities relate to expenses that qualify. So there are three categories. The first is our wages that are associated with these projects. The second are consumed supply expenses, and the third are outside vendor expenses. I'll talk about each one of these briefly. Before I do, I just want to add that this is a U.S. tax credit, and because it is, the government requires the activities and expenses to take place on U.S. soil. So, the one area I think about, software development, if somebody's developing it here in the US for you, and it's fine. But if they're overseas developing it, which happens to be the case a lot, then that expense would not be eligible for in the calculation of the credit. The other piece I wanted to mention is that the equipment that you buy that's put on your spreadsheet, that's put on your balance sheet and depreciated does not count. It's really just the wages or labor, supply expenses, and outside contract expenses. Okay, so let's talk about wages. Just quickly, if you have those like engineers or technicians, I notice a lot, maintenance people are often technicians, and they help in innovating in your processes or software development. These are core people conducting R&D, and maybe in a period of a year, maybe 80, 90, or 100% of the time might be related to this, or that might be their full-time job. Then that's an allocation that we look at and we say, okay, maybe 100% of these folks would count, their wages would count for that year. But the IRS also allows people who direct those activities, to the extent they do, to count. And so you might have, a general manager or somebody an executive or an owner that's directly involved with influencing what's happening with these activities. And to the extent they are, maybe half their time for a year or two or every year is involved with improving their, their product development process, or in a service operator environment, just the process. So if someone's time was 50% involved with this, then 50% of their salary would be included with that year's calculation of the credit. And what we're trying to do is that the larger the quantity of wages and other qualified expenses that exist, the larger the credit will be. So the more we uncover here, the higher the credit. And then you have senior execs, and if they're removed 2 by 2 places, or 2 levels or more, they would not their wages wouldn't qualify. However, and this is a big however, if they're influencing these activities, they're then called a supporter, like a quality control person that might be influencing the process improvement. They might say, hey, got to go back to the drawing board. These aren't coming out right. So their time would count to some degree. Production workers who are involved with testing and prototyping, their time should count during that period. But the senior execs, I can tell you that 95%, 90+% of they're involved in what we've seen in this industry. They're involved to a decent degree of they're always tinkering. They're always making sure the efficiencies are improved. So that's something that we look at, and therefore, to the degree they're involved, their portion of salaries would count towards the credit calc. A real example is of how we do it. The CEO, and we had almost 60% of their time involved. We use taxable wages only. That's an IRS requirement. So that's basically the gross wage less PTO, and that at 57% is 52,000. So that goes into the calculation of the credit. And we go through all the employees, and we figure out at the end that they had $501,000 in that year of qualified wages. Now, if that's all they had, if they had no outside contract expenses or whatever, then that would be the qualified research expense, and they'd get back as a tax credit about 50 grand, like I spoke to earlier. So that's how the wage work from a 10,000-foot level. What we do when we work with the clients, we really do help go through all of these employees, but believe me, it sounds like a lot of work, but it's not. We've got a method where it can really be done in a very pragmatic way, and it might take 3 hours. It won't take 3 days. So then the next category are qualified research expenses related to consumer supplies. I don't see consumer supplies too much with the operators, but I do with manufacturers. And the areas that do qualify are when any materials you use an expense for prototyping, or the scrap materials that you use, or any tooling and fixtures that are built and developed for that product that get actually trashed at the end. These things can't go back into inventory, but if they're expensed and trashed, they count, and we like to know about that. And some of the companies, manufacturers in particular, these can be quite large and really add to the amount of the credit they're eligible to receive. Excuse me, those are the consumed supply materials. I didn't, I hope I didn't say that. Okay, a message just came in. Okay, just a second. I just want to see who's, okay. Okay, couple quick questions. Just let me see if I can get this. Their phone was muted for some reason. Does the internal labor costs for installing more efficient laundry equipment qualify for the credit? So there's 2 parts to this question. So to answer that question, that the internal labor costs, if it's strictly for installing and not for figuring out the development of how it would be best installed and for efficiency reasons, it crosses a little bit into a gray area. If you were, I'll kind of give you a more black and white example. If you're doing a like-for-like replacement of a washer, that installation does not count. That time and expense does not count. There's no real improvement in development work being done. Yeah, you might research the product, but that doesn't count. We're talking about research or time and related to figuring out the planning and design end of it, not the installation, which might take a certain subset of time. And I don't know if I'm answering your question, but I hope I am. The second question is, if the project crosses tax years, are you able to take the credit for costs incurred in first year, or do you have to wait until project completion? That's a good question. So the way it works is if it crosses years, then the expenses related to each tax year. So if you're on a calendar tax year and you started a project in June of 18 and it finished in July of 19, to the extent that you had qualified expenses in 18, the second half of 18, you would use that for the 18 credit. In this, the extent you had those qualified expenses in the first half of 19, you would use those expenses for the 19 credit. Okay? Any others? All right. Thank you for those questions. Okay. Contract expenses, these are for outside third parties, vendors. Anytime you hire engineers to help with your development work, industry experts, sometimes you do third-party testing, and I always add in the software coders that, again, trying to make sure that we don't forget them, because they're often in your day-to-day life and you don't think about it as a cost that can count. Now, I've covered the activities and I've covered the expenses related to those activities. I wanted to just talk about our process and then talk about a couple case studies. So the way we work is that, you may be wondering, how does it work cost-wise and fees and all that? So we would do an evaluation with all of our clients and determine what qualifies. And we, on our end, might do a pretty good deal of work to figure that out. But we do that so that we can do a really good estimate of credits before we engage with our clients, so that our clients know what they can come very close to expecting in reality for the credits. And at that time, we would know, how much money we would want to charge for the work if the client went forward. And what we do here at that point is we come up with a fixed price proposal. The reason I talk about fixed price is because we want our clients to know upfront that have a 100% expectation of what they will pay. And it's usually, the credits are anywhere from 5 to 10 times the cost of our work. And, we do price very modestly in the industry. And, the fact that we do what we call fixed price is important to know, because the IRS frowns on practitioners like us who do it on a contingency basis. And that might be a question that someone might have had. I usually hear that. Do you believe in your work? Would you work on a contingency basis? The answer is no, we cannot. And some do still do it, but the IRS really frowns on it. So what we do is, by the time we're done with estimating your credits by working with you for a few hours, we'll know what our investment of time will be, and that's how we can come up with our fixed price. Then the question is, what do we deliver? So we deliver two things. We deliver the calculations, which are supported by the necessary financial work papers that your CPA would need to include in your tax returns to claim the credit. And we also do what's called technical supporting documentation. Before I speak to the technical supporting documentation, I just want to add that we work with CPAs across the country where it's a symbiotic relationship. It's not a competitive one, because we have engineers on staff, and we can do this very deep dive and do it right and come up with a quality product, if you will, a deliverable, and stand behind it. I think the CPAs have a comfort level. We probably work with 40 or 50 CPAs around the country working with their clients. The technical supporting documentation, I say, I kind of feel that's actually more important than the work papers for the financial piece, because, there aren't that many audits that take place in reality. In fact, the R&D credit, if you claim it, does not increase the probability of an audit, just so you know. But in that random chance that you're audited, whether it's for another reason or not, they might look at the R&D credit. This technical documentation that we write up is really kind of the key to how it gets defended in a very positive way. So what we do is we would write up a sampling of projects for a particular tax year, and we would explain why the activities related to those projects meet those 4 IRS tests that we went over. And that's really, this is really for your file. It's not needed while you're claiming the credit, but we usually do these first, and then this lags after. But by the time we're done with this piece, we'll end up giving you a binder that includes all of this information, and plus some other pertinent company information that we learned along the way, and it's all neatly done in one place. To do the financial work papers, it takes usually 4 to 6 weeks in general, and that's not full time. That's just the process. You might wonder how much time you have to invest in this process, and I can tell you that on the financial side, it's probably less than a half a day of the accounting and finance team's time. 4 hours of somebody's time, or 2 people's time, 2 hours. We like to have an hour meeting and go over the information that we need so that we can do the estimate of credits. But it's not a significant time sink on the client's part. And on the technical supporting side, documentation side, it might take, again, in total overtime, 4 or 5, maybe 6 hours of helping us write it up. So it's not, I would say, at all insurmountable. It's really something that it's some time, but usually well worth it in what you would get in a return. So that's the process that we go through. And I'm going to now just go to a couple quick examples, and then we can open it up to any other questions you may have. And we're just about done here with the slideshow. So here's a client that had, generally speaking, they needed and wanted to improve their process across their facility. It was not a minor undertaking. First of all, they were about 275 employees. They got back in 1 year, 150 grand federal credit with a 70 grand state credit. And again, as I mentioned before, you can do this every year. You have activities that qualify. I will say that sometimes particularly with linen service operators, I see a blip in activity across a couple of years, and there might be a year off, and then you're back at it again. But usually, but this is something that should be at least looked at every year, whether you go forward to claim the credit or not. And this company, was designing, new processes to move the linens throughout the facility. They had some internal use software that they developed for monitoring their production data, and they also did some rail system changes and many refinements to it. So they had a lot of different projects going on that qualified, and we equated it to the expenses that turned out to be these amounts of credits. This is a company that, and as I mentioned, I've run across quite a few that have this challenge. They have to develop or improve their current wastewater treatment system. And what they were doing is they had an expansion, and they really had to forecast their needs for how to treat the wastewater under greater demands. So they had to figure out what all the government standards were, the state and local criteria and laws. And they also had the problem that everything they looked at that might be more or less off the shelf was very expensive. So they did a hybrid where they customized a lot of their solution, which meant they spent a lot of time of their own, working with consultants or engineers, and therefore, their wages and those outside engineering time counted towards the credit. So, they were able to get $50,000. I rounded that number, but $50,000 credit back, and the state that they were in did not offer a state credit. One other company that improved their process, they were implementing new sorting and tracking systems, and they ran all sorts of simulations while maintaining their current operations, which of course is critical. And so just to figure out how to run the simulations and do that, that alone counted, but all these modifications they did up until then, those activities certainly added up. So they were able to get an $85,000 credit, and their state had a very lucrative credit of 60 grand. And all three of these examples, they were either S or LLCs, they were flow-through entities. So these credits were flowing through to the shareholders to be used against their personal income tax liabilities. And I think this is my last one. This is often the case throughout our industry, is that RFID and UHF chips have become very much the norm. And this company wanted to not only implement this new technology to their plant, but they created detection systems for automatically determining multiple data points to gather information, and they used the data to create these algorithms, and they had to go through a lot of customized software development at the same time. The planning and design of the UHF implementation, that time counts. And I'm often asked if the chips that are used while going through the process of figuring out whether it's going to work or not. Sorry, I was distracted. The chips themselves that are used, that generally, if it's only in the planning and design stage that would count, and it's not the purchase of the chips for the linens or uniforms that can count, even though they can be expensive. So that's the list of the case studies I wanted to go through. Were there some other questions? Okay. So does anybody have any questions you'd like me to follow up on? And if you do, you'd need to unmute your laptop or phone. Nobody? Okay. I think we've done it. We've fit it under an hour, and I appreciate all of your interest and time. And if you have any follow-up questions at all, you have my email address here and my phone number. And I'm very thankful for the opportunity to present to you. Thank you very much.